Hello, good morning, everyone. Thank you for joining us this morning for a webinar on the Capital Markets Union and the Savings and Investment Union, more specifically, what Swiss asset managers need to know about it. My name is Maxime Malherbe. I am Senior Legal Counsel EU at AMAS, and also Head of Policy and Advocacy at the Swiss Finance Council based in Brussels. In this webinar, we'll try and answer several questions. The first of them being, of course, what is this Savings and Investments Union that is making the rounds in Brussels? We'll also delve deeper into how Brussels works, or if it does work, before delving again a bit deeper into the core components of the Savings and Investment Union, and having a bit of a look ahead on what Swiss asset managers can expect in the coming year. As I mentioned, we'll start by setting the scene. Understanding where we are now regarding the SIU requires a bit of background. As a reminder, the current European Commission entered into force last year, and if there is a lot of follow-up to the previous one, it being composed of most of the same people, a lot of international events and external priorities have impacted the way that this commission not only works, but also on what it is focusing on. One core element that is different from this executive compared to the previous iteration of it is a centralization of power. We can clearly see that President Ursula von der Leyen has shifted a lot of the decision-making from the commissioners to her cabinet. This leads to a prominence of her political party in the decision-making process in the European Parliament due to the links between, of course, her cabinet and the EPP. What this means is a very top-down approach to decision-making in what the Commission is focusing on, and thus which sectors are impacted by this Commission's decision-making process. Despite a push on simplification, and I'll get to that a bit later, we're seeing the overarching theme of this Commission remaining sustainability and the digital transition. So there's this push to combine the previous Commission's agenda, digital transition, sustainability transition, and to take on board the ideas that were put forward by Mario Draghi and Enrico Letta in their respective reports on how to increase the competitiveness of the European Union. Despite this focus, the core thematic of this commission is on simplification. And while this was floated at the beginning as cutting down red tape and cutting down administration, what we're seeing is a lot of these simplification drives reopening of existing frameworks, sustainable finance being one, but also defense and also investment being another. We're seeing these open files, these reopened files becoming new battleground where while simplification remains a driver, there is always this risk of piling in more and more legislation while trying overtly to simplify. So there's a bit of this tension going on in what we're seeing on simplification. Again, and here I'll touch upon it a bit later. Despite this push on simplification of existing files, there is also a push for new files. And this is where the Savings and Investment Union enters. So the Saving and Investment Union, and again, I'll get back to that. It is in essence, if you need to present it in one sentence, it is a rebrand of a 10 to 15 year project, which is at the same time a unified capital markets union across the European Union member states, and also a banking union. So it's this rebrand, this revivification, and this replanning on how to achieve these objectives of a banking and a capital markets union. Reality comes knocking quite often on the Commission's planning. And these years, that reality is highly geopolitical, which means that the Commission's agenda is often shaken, changed, and the timelines are very variable. What we're seeing now, of course, is you won't, notably as Swiss asset managers, be uninformed on the tariff issues facing not only the EU but Switzerland as well. And we're seeing this rise of competitiveness on the international stage, of geopolitical tensions, and of this and this is translated in a more protectionist agenda, if not vocally, at least in practice. And we're seeing this trickle down to the Commission's decision-making process. One other stakeholder I would be remiss not to mention is the core one for us in financial services, which is Maria Luís Albuquerque, who is a Portuguese economist and politician, served as Minister of State and Finance of her state for 2 years between 13 and 15, and before that held some treasury roles. So she was nominated and confirmed as Commissioner for Financial Services and the SIU in 2024. Her broad positioning is as a fiscal conservatist. So domestically, she's notably associated with the tough consolidation measures that were applied in Portugal during the sovereign debt crisis. She has a very structured, pro-market, pragmatic view, and really framed her role around unlocking financing for the EU's green, digital, and social transitions. So she really speaks publicly in favor of measures to make European financial markets deeper and create these elusive European champions, which the European Commission seeks to foster. So what's her role? What does she do? So her portfolio really, as mentioned, is a high-profile economic and regulatory one that deals with banks, capital markets, retail investments, and rule making of this at the EU level. Her political standing in the Commission is strong, but has been not under threat, but has been impacted by her positioning on several files, where she put her political capital on maintaining some files on the agenda, notably the retail investment strategy, which didn't sit well with Ursula von der Leyen, who, from what we gather, wanted that file to be removed. So despite this, there's a clear trust in her technical credibility on banking, public finance, and wider financial services topics. And she was notably grilled and found agreeable by the European Parliament in 2024. Despite this, there's some challenges and risks that she's facing. Notably, domestically in Portugal, she's quite a polarizing figure because of the austerity policies that were associated with her time as finance minister. There is also some scrutiny on some conflict of interest issues, notably with some commentators and civil society players raising concerns during the nomination phase about potential conflicts, notably with the banking sector. And then there's her mandate, which is in essence balancing growth and stability while putting into place a simplification agenda and really dealing with the failures of the last 15 years, or at least the slow pace of implementation of the capital and banking union of the last 15 years. So what can we expect from her? What have we seen from her already in the last years? It's really her focus on pushing for deeper capital markets, retail participations, and measures to help EU firms scale while having a clear emphasis on financial stability. As I mentioned, there's a clear technical credibility and the backing from her commission, from Ursula von der Leyen and her cabinet on this. But those political flashpoints, domestic austerity record, questions on these conflict of interests, and sustainability reforms keeps her really under close scrutiny, both from civil society, but also from the other players, institutional players in the EU, which are the Council and the European Parliament. So that's a bit setting the stage players-wise. Again, as a quick recap, the EU lawmaking and policy process is headed by three entities, three co-legislators: the European Commission, who proposes legislation, and then the European Parliament, which is democratically elected amongst member states, and the Council, which is represented by the national governments of these member states, look at the Commission's proposals and negotiate between themselves to find a final text. What you need to remember about this process is that it is eminently bureaucratic at the beginning, very negotiation heavy in the middle, and that it takes some time. From the moment the Commission starts thinking about a legislative proposal to the moment it enters into force, we're looking at least between 2 and 5 years, and the negotiation process itself can last between 6 months to 3, 4, 5 years, again, depending on the policy divides that we see between member states and the European Parliament. European Commission legislative proposals do not come out of nowhere. The Commission's agenda is very structured. It is publicly shared on a regular basis. At the beginning of the Commission's mandate, it lays out its 5-year plan, and then at the beginning of every year, the Commission publishes its plan for the year. You'll see here on the slides some examples and possible origins of these legislative proposals. The international level is another source of political impetus for the Commission to put on a proposal. And then the one we'll be focusing here on is both the political integration projects, here CMU, Banking Union, SIU, but also we'll touch a bit later on how the review of existing legislation works. As part of the SIU, we'll see some existing legislation being impacted. And here's where notably I'll be talking about UCITS and the upcoming Eligible Assets Directive review that we are expected. What does it mean for us? It means that as Swiss asset management industry, the earlier we discuss our issues with the Commission, the earlier in the process we are, the better and the clearer our views will be heard. Whilst there's often not a direct impact of EU legislation on Swiss asset managers due to Switzerland being a third country, due to the ties between the EU and Switzerland, the impact is very real. And due to the products and financial products that you work with every day, and a lot of their European focus, notably here, UCITS, the impact of EU legislation on the Savings Investment Union is direct and clear, both on your strategies, on your portfolios, but also on the horizon of those strategies themselves. You'll see here again on the slide a timeline, an indicative timeline of how the EU legislative process works. And here again, I'll stay relatively high level. At the beginning, the Commission enters what is called a consultation stage, where it seeks input from a lot of different sectors, being civil society, but also the private sector. And it also seeks early member state approval and member state views on what the legislative proposal will be. So this is really the information and analysis stage that takes place slightly before the proposal is published, but also after the proposal. Also, before a proposal is published, the Commission puts out what is called a consultation process, which means that it will provide industry and civil society with an opportunity to share early views on what it is looking to propose. And this is really the moment, one of the clear moments where AMAS structures your views in order to put them forward to the European Commission and in order to impact any proposal that comes out. Then we enter really the political phase where the European Parliament, Council will seek to find their own position, their respective positions on texts before entering the trilogue phase, which is the interinstitutional negotiation phase, where Commission, Council, and Parliament will negotiate between themselves in order to then adopt a final text and then implement it. Hopefully, this gives a good idea of who the players are, how the process works, and then now we'll delve into the Savings and Investments Union itself. So, as an elevator pitch, the Commission would put the SIU forward as a strategy. And this is a strategy to take the Capital Markets Union's current status, which is one of fragmentation, and to push towards this unification. What is different compared to the Capital Markets Union, which was almost a decade, even a bit more long objective born under the Juncker Commission to create this union of capital markets across the EU, is that the Savings and Investment Union ties it to the deeper banking union. And the aim here is to target a single, more efficient EU financial ecosystem that channels household savings into productive cross-border investment, while at the same time strengthening single supervision and market infrastructure. So it's really a strategic refresh of the EU's capital markets, which was launched in 2025. It doesn't come out of nowhere. It is born of the acknowledgement that the capital market union, banking union, is advancing too slowly, and is also spearheaded by, and I'm sure you've heard of this report, is the Letta report, which aims to provide solutions and avenues forward to the European Commission, to the European Union's current economic malaise, by notably channeling that retail investment into the EU economy. So its overall goal of this SIU is to unlock this large pool of household savings. Commission numbers cite around 10 trillion in bank deposits that it is seeking to unlock. And again, and here the further objective is channel these investments and this private capital into strategic investments. So it's not entirely new, and it seeks, compared to the Capital Markets Union and the Banking Union, to have a more practical focus. So you'll see here on the slide the issues that were identified early by the Letta reports and then by the Commission to solve. Supervision is, of course, here one of the core pillars, which is, well, the EU Capital Markets Union is in essence 27 capital markets with their own specificities and with a lot of supervisory arbitrage, which does not abide for this structuring and unified union that the Commission is looking at. They're also looking at securitization, which is not a vivid market here in the EU. SME growth, transitional finance, artificial intelligence. There is this overarching push and maintenance of financial stability that is also a focus. We're seeing those also on the non-banking financial intermediaries debate, with the rise of a lot of new players, be they neobanks, neobrokers, crypto assets. We're seeing a lot of focus on this maintaining financial stability. And another focus is this focus on seeking to attract private capital for the financing needs of the EU economy. And here, another focus here is on defense, notably with the war in Ukraine, on how to structure that financing, those financing needs in order to fortify the EU's defense sector. I won't go too in depth into these details, but just to highlight that these are the core issues that have been identified by Letta. The response of the Commission to this is four distinct pillars. And you'll see further down the line that the SIU is structured, the proposals in the SIU are structured around those pillars. The first one is on fostering the single market itself. And here we're seeing some push around cross-border fund distribution, the harmonization of fund structures, fund passporting, and the simplification of taxation and reporting. One big caveat here is that a lot of these issues are member state focused, which means that the SIU, in essence, is seeking to tackle these persistent failures in the capital markets and banking union framework, um, which are still and remain the purview of member states. So a lot of the political feasibility of what the Commission is proposing now depends, one, on smart sequencing of its political proposals, but also on the political resistance that we're seeing from member states. And this is really the crux of the issue, is that whilst member states politically and at a very high level support the measures that you'll see here on this slide, at the negotiating level, there's a lot of friction. And there's a lot of topics here, notably here, the harmonization of tax regime and reporting standards that touch upon national legal taxation and insolvency regimes, which remain the purview of member states. What this means is that a lot of the initiatives in the Capital Markets Union will end up being very different from what the Commission proposes to what the final result will be. And it also means that the Commission is actually reviewing its initial considerations and putting forward its proposals through different legislative vehicles. And these legislative vehicles often are downgraded from directly applicable in all member states to more guidance and recommendation frameworks. So a lot of what we're seeing here will be diluted. Another consideration to take into account, and here this also links to the timeline issues mentioned at the beginning, is that the Commission is seeking to act on very short timelines. So we're seeing it front load several of these concrete initiatives. Notably here, securitization, a blueprint for an investment and savings account, a market infrastructure packet, and its supervisory simplification package. So this really signals an urgency from the Commission, and this goal to achieve an early tipping point progress within the first half of the mandate. As I explained, a lot of this is done through a mix of legislative and non-legislative tools. So it uses recommendations, communications, and legislative proposals, which are often more practical due to notably in the more politically contested items, where member states can just signal with a nod that they agree with the overall objective of the Commission. However, in practice, we'll see a lot of log rolling and politically infused debates on the more detailed focuses. Another issue is that even if the SIU is nominally a fusion of the capital markets and the banking union, the legacy of the banking union remains a constraint. A lot of SIU measures explicitly depend or interact with the banking union work, and so any delays in the banking union completion will affect the savings and investment union scope and pace. What are the SIU's core components? As I mentioned above, there's these four pillars. However, the core components that we're seeing at the moment are, not using the correct slides. Up, there we go. Are front-loaded at the beginning of this commission's mandate. I'll focus here on several. On the citizens and savings bucket of components, we're seeing the Commission putting forward the EU blueprint for a savings and investment account. So this is a non-legislative blueprint that seeks to provide national competent authorities with guidelines to implement cross-border accounts that make it easier for retail savers to invest into capital markets product. This is expected to come out this month. We're also seeing a focus on a retail investment strategy, and I see my slides moving along quite quickly. Apologies about that. So this retail investment strategy, which is an overarching package which targets both the MiFID frameworks, but also suitability, distribution, product design, and incentives to increase retail participants in EU markets. So this is work that is also ongoing. Also this month, you'll see published a financial literacy strategy, which is seeking to provide, again, a non-binding blueprint for member states to boost investor literacy and confidence. There's also going to be work on pensions with recommendations, again here non-binding, on auto-enrollment, pension tracking, and dashboards to boost, again, long-term retail savings via these retirement products. A focus of ours is on investment and financing. I'd be remiss not to mention the securitization review, which again here aims to revive simple, transparent, and standard securitization as a tool to free bank balance sheets and channel credit to SMEs. But more of focus to us is the recent Commission package on market integration and supervision. So this is a package which contains several legislative proposals which aim to reduce cross-border friction within the EU. So here we're looking at post-trade, settlement, custody, and operational barriers for asset managers, but also improve this cross-border provision of funds and reducing these operational barriers, which is here really aimed at impacting and reducing the gold plating that we're seeing between member states. Linked to that is single supervision. So this is a long-term Commission objective and one of the clear, in the Commission's view, unblocker of the capital of a single market for capital and for banking is one single EU level supervisor. ESMA, it could be ESMA or it could be a new one, in order to reduce fragmentation and strengthen crisis handling. So again, you see here this focus on financial stability. So again, looking at the slide, a lot of the preparatory work has not started. What we're seeing front-loaded is encouraging retail participation and the market integration and supervisory packages. Again here, more detail, this initial package on the integration of EU capital markets has already entered what I mentioned earlier in the process, which is this consultation phase, meaning that the Commission shared with civil society and industry its initial views and objectives on what it would do in order to target these barriers to cross-border fund distribution, but also supervisory fragmentation and inefficiencies in passporting and group-level structures. Does this impact Swiss asset managers? Yes, but the focus here is in intra-EU fragmentation and intra-EU cross-border transfers. So third countries were not really a focus of the Commission here at the moment. That being said, it provided an opportunity for us to share initial views on these packages. And whilst this consultation did cover a wide range of technical and structural issues, again here from trading and post-trading to asset managers, these themes of simplification and supervisory convergence do cut across all sections. Um, our input was fourfold. The first and really key element that we brought forward is to allow third country jurisdictions and firms to contribute directly to the savings and investment union. Um, Here, we propose to develop an institutional-based approach that could offer a single point of entry for third country firms to provide cross-border financial services to the benefit of EU capital markets, in particular for closely connected markets such as Switzerland, with this level of high regulatory supervisory standards, and this equivalent, if not equivalent, at least very high standards. Well, they're not deemed equivalent by the European Commission, but that's a political decision and not a practical one. Three other points that we made is to really focus on speed and simplification, and to consistently apply this risk-based proportionality across all EU financial regulation, and avoid the wholesale directive to regulation conversion of regime merge. What this means is do not harmonize where no harmonization is needed, and where the current framework and structure between national competent authorities works. Another focus of ours here was to enhance coordination rather than create any new supervisory bodies, which would just pile on these additional requirements and these additional regulatory focus. One other focus of ours was to streamline fund passporting rules. And here we pointed at a lot of member states who gold plates, notably UCITS and FMD notifications with extra filings, approvals, low marketing material, public notices, cost and administrative burden. All this gold plating that we're seeing at the moment is one of the main hamperings to this capital markets union, and also is costly and time consuming. And again, linking to my earlier point, a focus on supervisory convergence, which means here that the benefits of single supervision, while they can be realized under the existing passporting framework, and by empowering ESMA and NCA coordination without, again, this risk of additional redundant supervisory levels. The next step in this particular package is the publication of Commission proposals, which we are expecting end of this month, early next one. Once this is done, once we have a clear picture of what the Commission is proposing, then the negotiation phase can begin. The European Parliament and the Council will both seize the Commission text and negotiate between each other in their respective hemicycles in order to find their respective versions of the text. This provides us with an avenue, again, to share our message and to target more in detail the upcoming Commission's proposal, and to change where needed, or to seek to change where needed, any negative impact on the industry. So this is a process that will take 6 months to a year, likely the negotiation one, and which we will be busy on in end of 2025 and early 2026. So this is for the current focus on which element of the SIU are being negotiated at the moment, which are oncoming. So as I mentioned, the financial literacy strategy, the investment savings account guidelines, and then for a bit of a more forward-looking look ahead, there is another key focus of ours at the moment, which is the review of the Eligible Assets Directive. So you'll see here on the slide an interesting quote by Michel Barnier, feu and a short-lived French Prime Minister, and at the time Market and Services EU Commissioner in 2014, is him really putting UCITS on its deserved pedestal as a gold standard for fund regulation globally, and that the UCITS brand is really a benchmark, or at least a gold standard for the industry globally. That being said, ESMA, so the European Securities and Market Authority, was mandated through the previous iteration of UCITS that came into force in 2014 to provide a report and technical advice on a review of the UCITS Eligible Assets Directive to the Commission by June of this year. ESMA's advice is, as it's named, advice, so it is non-binding. The Commission has no legal obligation to take it on a one-to-one basis and to publish it as is, as its legislative proposals. So it's just to highlight the non-binding nature of the EAD. That being said, ESMA's advice, as it is done now, it sets out, in essence, a very prescriptive approach to a lot of core elements of UCITS. ESMA's core message is that it recommends this more prescriptive, harmonized UCITS eligibility framework to improve transparency, liquidity safeguards, and consistent application across the EU. In detail, this means that ESMA is really pushing for a mandatory look-through that would require managers to look through all underlying assets for at least 90% of a UCITS portfolio, so that exposures are transparent but also accessible. ESMA also proposes a limit on alternative exposures, so up to 10% of a portfolio value as indirect exposure to alternative assets, but only with strict liquidity and valuation. And if strict liquidity and valuation safeguards are met. ESMA also provides an eligibility table to clarify how this look-through approach applies to different vehicle types. In short, ESMA's proposal should not be adopted wholesale by the Commission because it really seeks to fix a framework that is not broken. It is also quite against, or as it stands, can be judged against the Commission's SIU objectives and found wanting. As it stands, ESMA's proposal and the complications that would arise for asset managers work actively against the Saving and Investment Union's objectives, goals, which is to bring capital to the real economy, boost retail participation, and improve competitiveness and simplification. Our early view, and a view that is really shared by the industry, is that again, this should not be implemented wholesale, and the changes that ESMA is proposing to UCITS are not minor, even though ESMA puts them forward as minor, and these would risk regulatory instability, damage of confidence, and undermine these SIU objectives, as I mentioned earlier. So you'll see on the slide that this would have a direct impact on the Swiss asset management industry, and notably, and I believe there's several articles that came out in the press on this, regarding the ESMA recommendation that catastrophe bonds should not be permitted investments in UCITS and are better treated under AFMD due to their structure being closer, and here I quote, closer to insurance products than a traditional transferable security. So this would again force managers to exit or reduce their exposure to cat bonds, which in Switzerland, these assets based on early analysis would risk between 2 billion and 4 to 7 billion holdings, and this. Again, this impact would compress the market, raise hedging costs for insurers, and in essence, not only impact disproportionately the Swiss asset management industry, but the EU and the global one as well. To go quickly through the early risks and more of these early risks and early messages that we are sharing and that the industry is sharing with ESMA and early with the Commission, is that, again, once more, this ESMA proposal as a blanket change to UCITS should not be implemented wholesale. UCITS should be treated very cautiously due to its force as a gold standard. It's a global, stable brand. It's a cornerstone of EU capital markets, and its stability has fostered investor confidence and cross-border distribution. ESMA also does not bring quite convincing evidence of widespread investor detriment that would justify those major rewrites. When we look through step by step ESMA's changes, ESMA's proposed look-through mandate could reclassify a lot of current lawful UCITS strategies or force these funds to become AIFs. And there's no ready-made EU-wide retail AIF substitute with the same cross-border passport, which would risk capital flight out of the EU. The same requalification would hurt institutional investors as well, and third country investors as well that must buy UCITS. This fragmentation of pooled capital that was result from the reclassification, notably through national AIFs within the EU and other mandates, would again reduce scale and raise those costs. There'd also be a very large loss of non-EU distribution as global investors would shift their funds and look to more local alternatives. The impact on the real economy is also not to be put down, restricting these eligible assets. So I mentioned the catastrophe bonds, but there's also other instruments, notably Delta ones, which would be restricted. Again, could reduce financing capacity and force liquidations without, again, this proven failure that would require such a reclassification. ESMA's whole proposal changes to liquidity rules would again here disrupt the current regulatory framework of UCITS, which is one of its strengths. It's the current level 1, level 2, but also the ESMA guidance portfolio that we have and the stress testing portfolio that is in place. In essence, these changes there's not a need to fix what is not broken. And there's also a risk of oversimplification here by removing useful diversification tools that improve risk management and returns. From our perspective, again, despite ESMA's advice being non-binding, and despite being at a very early stage in the process, it would be interesting. It would be a good step to start considering how such a look-through regime and possible 10% indirect exposure cap would affect in detail fund structuring, documentation, but also liquidity testing and disclosure and more operational processes. Due to the fact that this is very early days, a lot of this data and arguments there are still to be built in a tangible way. And here I'll focus a bit on the timeline. Is that despite ESMA's technical advice having come out in 2026, it is non-binding. There is currently no clear indication that the Commission considers a deep review of UCITS EAD a priority. From informal sources within DG FISMA, so the Commission Directorate General in charge of this, they have not started looking at it yet. However, being early in this debate and being able to quickly, strongly, and directly share this early view that ESMA's guidance is not required is key. Um, when will we know exactly if the Commission will be taking this on board? In a couple of weeks. On the 21st of September, the Commission will publish its 2026 work program. And notably here will indicate if a review of UCITS EAD is on the docket. Timeline-wise, what does it mean for us? It means that this is a topic to follow very, very closely. That the legislative and drafting process has not started yet and can still be impacted, not only now, but in the coming months that lead to the Commission putting forward any legislative proposal and the consultation that will precede this. Notably, this consultation will be a key milestone for us because it will allow us to, in detail, go to, and respond directly to what the Commission is thinking to put forward in any proposal in a structured manner. So again, here to highlight the importance of this, the timeline, and any implementation of changes to this would not be at least until a 3-year horizon in the EU if this proposal process starts in 2026. If it's pushed back, this is subject, of course, to change. Going back to our early questions, I hope this webinar provided some tools to answer not only where this focus on the SIU and CMU comes from, who is in charge, and the core dynamics that we're seeing at the Commission level, the composition of the packages that the European Commission is expecting to come out with in the coming years, and also the salient ones that we will be focusing on now and in the year to come as AMAS. I'll stop here with 12 minutes of questions and answers. Please don't hesitate to use the chat tool to do so. Thank you very much for your time. Since I see that there's no questions coming, we're always at your disposition for any question you might have. Please don't hesitate to share those through AMAS, and happy to enter into any bilateral conversation, not only on this topic or any other EU impacting topic that might be of interest. We'll stop here. Thank you very much for your time, and I wish you a great rest of the week. Bye-bye.